Ever wondered how some people make their money work for them instead of working for money? Welcome to the intriguing world of investing, a realm where your money can become your most diligent employee, working tirelessly to generate more wealth for you while you focus on other aspects of your life. Investing, at its core, is the act of committing your resources with the expectation of achieving a profit or material result in the future. It's like planting a seed today and waiting for it to grow into a fruitful tree over the years. Unlike saving, where your money sits idle, investing allows your money to grow, multiply, and create a stream of income over time. It's a strategic approach to wealth creation that relies on the power of compounding and the dynamics of the market. But investing isn't a one-way street to riches. It's a journey filled with potential rewards and risks. The stock market, for instance, is known for its unpredictability. It can surge to new heights one day, only to plummet the next. Real estate investments might offer lucrative returns, but they also come with their own set of challenges. Even something as seemingly safe as a savings bond carries the risk of low returns due to inflation. Yet, the allure of investing lies in its potential for high returns. With the right strategy, knowledge, and patience, investing can turn a modest sum into a substantial fortune. It can help you achieve your financial goals, be it buying a house, funding your child's education, or securing a comfortable retirement. Remember, investing isn't a get-rich-quick scheme. It's a long-term commitment that requires careful planning, constant learning, and informed decision-making. It's about understanding the market trends, diversifying your portfolio, and balancing risk and reward. Investing is not just about making money. It's about reaching financial goals and securing your future. It's a journey that can lead to financial freedom and open doors to opportunities you never thought possible. So are you ready to embark on this exciting journey? Let's dive deeper into this fascinating world and understand the different types of investors in the next scene. Investors aren't all the same. They have different goals, different strategies, and different risk tolerances. Let's delve into the world of investing and explore the three main types of investors: conservative, balanced, and aggressive. Firstly, we have conservative investors. These individuals or entities prefer lower risk investments, such as bonds, certificates of deposit, or money market funds. Their primary goal is to preserve their capital and maintain a steady flow of income. They are not so much concerned about striking it rich as they are about keeping what they have safe. They are the type who would rather have a small, assured gain than a chance at a larger one. Next, we have balanced investors. They are a blend of the conservative and aggressive investor. Balanced investors aim for a mix of income and capital appreciation, and they are willing to accept moderate risks to achieve their goals. They often invest in a diversified portfolio that includes both stocks and bonds. Their investment decisions are typically based on a careful analysis of market trends and economic fundamentals. Lastly, we have aggressive investors. These investors are willing to take on a high level of risk in their quest for high returns. They invest heavily in stocks, commodities, and other volatile markets. Often, they are looking for the next big thing, the investment that will skyrocket in value. They understand that they could lose a significant portion, if not all, of their investment, but they are willing to take that risk for the potential of higher returns. Each type of investor has a different approach to managing their investments, and it's not uncommon for an investor to shift from one type to another over time, depending on their life situation, financial goals, and risk tolerance. So, whether you are a conservative investor who prefers to play it safe, a balanced investor who seeks a mix of safety and growth, or an aggressive investor who is willing to take on high risks for potentially high returns, it's important to understand your investing personality. Understanding your investment personality can help you make informed investment decisions. Conservative investors, as the name suggests, prefer safety over risk. If investing were a road trip, these folks would be the ones buckling up and sticking to the speed limit. They're not interested in the adrenaline rush of high-speed chases. They're in it for the secure, steady ride. A conservative investor is like a seasoned chess player, meticulously planning each move and always thinking a few steps ahead. They're not in a hurry to reach the finish line, but rather, they're more concerned about not losing their pieces along the way. They're the tortoises in the race, slow and steady, believing that patience and caution will ultimately win the day. They gravitate towards low-risk investments, such as government bonds, certificates of deposit, and blue-chip stocks. These are the bread and butter of the conservative investor's portfolio. These types of investments may not offer the highest returns, but they provide stability and predictability, which are highly valued by conservative investors. Their investment horizon is typically short-term. They're not keen on locking their funds for extended periods and prefer investments that offer liquidity. This way, they can quickly reallocate or withdraw their funds if necessary. But perhaps the defining characteristic of a conservative investor is their emphasis on capital preservation. They're not so much interested in growing their wealth as they are in preserving it. The thought of losing their hard-earned money is a nightmare they'd rather not live. So they tread carefully, making sure each step they take is on solid ground. It's like being at a buffet with a wide array of exotic dishes, but choosing to stick with what you know and love. It may not be the most exciting option, but it offers comfort and familiarity, with no unpleasant surprises. Conservative investors may not make huge profits, but they sleep well at night knowing their money is safe. They might not grab the headlines with dramatic gains, but they're the ones who can weather a storm, come out the other side, and still have something to show for their efforts. Conservative investors may not make huge profits, but they sleep well at night knowing their money is safe. Balanced investors, on the other hand, are willing to take on moderate risk for moderate returns. This breed of investors is the embodiment of equilibrium in the financial world. They are the Goldilocks of investing, not too cautious, not too daring, but just right. So, what exactly characterizes a balanced investor? 3 key traits primarily: diversification, a mid-range investment horizon, and a balanced approach to capital preservation and growth. Let's start with diversification. Balanced investors understand that not all their eggs should be in one basket. They spread their investments across a variety of assets, such as stocks, bonds, real estate, and even commodities. This strategy mitigates the risk of a single investment going sour and wiping out their entire portfolio. It's like having a backup parachute when skydiving. If one fails, the other can still save the day. Next, we have the medium-term investment horizon. Unlike conservative investors who play the long game, or aggressive investors who seek quick gains, balanced investors fall right in the middle. They typically look at a time frame of 5 to 10 years. This allows them to ride out short-term market volatility while still having the flexibility to adjust their investing strategy as needed. Finally, balanced investors strike a delicate balance between capital preservation and growth. They aim to grow their wealth, but not at the expense of losing their initial investment. It's a bit like a tightrope walker, always adjusting and rebalancing to stay upright. They might allocate a part of their portfolio to more conservative investments for safety, and the rest to more aggressive assets for growth. In essence, balanced investors are the embodiment of the old adage, "Don't put all your eggs in one basket." They understand that a well-balanced, diversified portfolio can weather the storms of market highs and lows. They are neither too fearful of risk nor too reckless in their pursuit of returns. So, whether you're a seasoned investor or just starting out, the balanced approach offers a middle ground. It's a path that seeks to blend the best of both worlds, offering a moderate level of risk for a reasonable level of return. Balanced investors strike a balance between risk and return. Then, there are the aggressive investors who are willing to take on high risk for high returns. These are the adrenaline junkies of the investment world, always on the lookout for the next big opportunity. They're the ones who aren't afraid to put their money where their mouth is, and their approach to investing is just as bold as their personality. Aggressive investors are characterized by their preference for high-risk investments. This is not a game of chance for them. Rather, they see it as a calculated risk. They're drawn to investments that others might shy away from due to their potential for high returns. These can include volatile stocks, cryptocurrencies, or emerging markets. Where others see uncertainty, aggressive investors see potential. But it's not just about taking risks. Aggressive investors typically have a long-term investment horizon. They're not looking for quick wins or instant gratification. Instead, they're playing the long game, willing to weather the ups and downs of the market in the hope of reaping substantial rewards in the future. They understand that the road to high returns is often paved with volatility and are prepared to stay the course. Their focus is on capital growth over preservation. While some investors might be content with preserving their wealth and earning a steady income, aggressive investors are all about growing their capital. They're willing to risk losing some or even all of their initial investment for the chance to earn significantly more. This isn't a strategy for the faint-hearted, but for those who can stomach the risk, the rewards can be considerable. Aggressive investors are often experienced and knowledgeable. They're not reckless gamblers but informed decision makers who understand the markets and are comfortable taking on more risk. They're proactive, always researching and staying ahead of market trends. In conclusion, aggressive investors are not for everyone. They embrace risk, have a long-term investment horizon, and prioritize capital growth over preservation. Their approach can lead to high volatility, but with high risk comes the potential for high returns. As the saying goes, no risk, no reward. Aggressive investors may face high volatility, but they aim for high returns. So, whether you're a conservative, balanced, or aggressive investor, the key is to know your financial goals and risk tolerance. We've explored the fascinating world of investing and the different types of investors. We've seen how each type has a unique approach, reflecting their financial goals and risk tolerance. Understanding your investment personality is paramount, as it can help align your strategy with your goals and manage risks effectively. Remember, investing is not a one-size-fits-all approach. It's a personal journey that requires patience, knowledge, and discipline.